In this lecture, we're going to provide some guidance related to audit evidence. Audit evidence, as defined by the auditing standards from the PCAOB, is information that is used by the auditor at arriving conclusions on which the auditor's opinion is based. It consists of information that either supports or contradicts management's assertions regarding the two areas that we audit, the financial statements as well as the internal controls over financial reporting. And again, keep in mind that the PCAOB is considering the audits of publicly traded companies, so these are the integrated audits. Again, both of the financial statements as well as the controls over internal controls over financial reporting. There is a relationship between risk and evidence. You notice the key words here: appropriateness and sufficiency. So let's talk about these terms and understand how these work together as we are developing an audit plan and the type of evidence that we are actually using. So the term appropriateness relates to the relevance and reliability of the evidence. This is the quality of the evidence that the auditor collects. Now we'll talk specifically about relevance and reliability as it relates to appropriateness, but keep in mind that these are the two terms that drive appropriateness. You notice the next term is sufficiency. Sufficiency is the quantity of evidence that the auditor collects. So remember, we are auditing based upon a sample of the population. So the sample size is a determinant of the sufficiency. Finally, risk. Risk is that there is a risk of material misstatement. So when we're looking at the relationship between appropriateness and sufficiency, we need to consider risk. We're considering these two areas, including inherent risk and control risk. And as we've talked about before, inherent risk and control risk define the risk of material misstatement. The key word is that the risk of material misstatement determines the nature, timing, and extent of the audit evidence that we collect, whether for the financial statement audit or the audit of internal controls over financial reporting. So again, the key words are the nature, timing, and extent of this evidence. And this is driven, or the decision in terms of these quantifiable determinants of evidence is driven by the risk of material misstatement. The appropriateness of the evidence, a measurement of the quality of the evidence. This includes the relevance. We'll get into this a little bit further, but basically when we're talking about relevance is we're relating the evidence to the assertion being tested. Again, keep in mind that the financial statements are the responsibility of management. So what we're looking for is we're looking for developing testing to test these assertions. As we've talked about before, the assertions are the explicit or implied representations that management makes in regards to the financial statements. The reliability, whether or not the evidence is convincing. Keep in mind that the key word here is convincing. However, we need to keep also in mind that we're many times not able to be convinced, but only persuaded. Well, why is this? Well, an audit must be completed in a reasonable amount of time at a reasonable cost. The auditor examines only a sample of the transactions that compose the account balance. Also, due to the nature of the evidence, the auditor must often rely on evidence that is not perfectly reliable. Audit evidence has different degrees of reliability, and even highly reliable evidence has its weaknesses. So we strive for convincing, but we need to keep in mind that in many cases we can only reach the level of persuasion in regards to the evidence that we're considering. The relevance, as we've talked about before, relates to the assertion. But keep in mind that relevance relates also to what we're actually doing, whether we're in the risk assessment stage, the test of controls, or substantive procedures. So relevance as it relates to the risk assessment is what we're attempting to do is identify relevant risks of material misstatements. When we're doing our testing of controls, we are evaluating the effectiveness of internal controls in detecting, correcting material misstatements. So the risk of material misstatement is based upon our risk assessment, where we are assessing these inherent risks, our test of controls, where we are testing the control risk of the organization. And as we're looking at this from the perspective of relevance, is what we want to determine is making sure that we're actually testing for these risks that actually have an impact on the materiality of the financial statements. Finally, our substantive procedures. Keep in mind that substantive procedures are the procedures where we are measuring monetary misstatements. Substantive procedures are the procedures that we use that form the basis of our opinion. So relevance related to this clearly is going to be based upon the management assertions, and it provides direct evidence about the presence of material misstatements. When we talk about the audit evidence and relevance, it's very important that we understand how the relevance relates to management assertions. I have a very quick table here that actually relates audit evidence to assertions, and what we're looking at is we're looking at two assertions, occurrence and completeness. Now, the interesting thing related to these is completeness and occurrence basically complement each other. Completeness essentially says that everything has been recorded, and occurrence says that everything that has been recorded actually occurs. Keep in mind that if we're looking at assets, instead of saying occurrence, we're going to use the word existence. And this relates to both assets as well as liabilities. But you notice in this bidirectional model is we have on one side the source documents, on the other side the journal or the ledger. So if we are vouching for occurrence, what we're looking at is we're determining whether everything that has been recorded actually occurred. So if we're looking at sales transactions, we identify some sales transactions based upon our sample, and then we go to source documents. Source documents may be shipping invoices, and determine if in fact the item was shipped and validity that the sales transaction actually occurred. On the other direction, what we're looking at is completeness. Again, what we're looking at here is we're trying to determine if everything that actually occurred actually was reported. So again, we would take a sample of these source documents and then trace these to the journal or the ledger and make sure that these items actually were recorded appropriately. And we want to focus our attention on misstatements that are likely to occur. So when we think about assets and revenue, we're concerned primarily related to overstatements. So we'd be very interested in taking a look at the items that were reported and then go out and determine if the assets actually exist and if revenue actually occurred. If we're looking at liabilities and expenses, our concern is going to be related to understatement. So what we're going to do is we're going to look at these the source documents that essentially show that a liability exists or an expense actually transpired, and then determine if in fact these things were reported in the financial statements. Again, this does not mean that we're not going to do tracing and vouching for all of these groups, but what we're looking at here is we're looking at the types of possible misstatements. So what we're trying to think about is what the organization may be doing if in fact they wanted to manage their earnings or to manipulate the financial statements. Certainly they would be interested in overstating assets and revenue and understating liabilities and expenses. So this is where the focus is going to be based upon our testing. When we think about evidence and the relevance of evidence, we need to consider that evidence is direct Direct is specifically related to an assertion. We've gave a couple of examples of this as we were considering the occurrence and completeness, but also indirect evidence. Indirect evidence is not necessarily directly related to a specific assertion. It certainly is going to be insufficient when there's a high risk of material misstatement, but it does require a linkage or inference to provide assurances. So what we're basically saying here is that everything that we look at, everything that we do becomes evidence. So the indirect evidence, maybe if we go to an office and it's messy and they can't find the documentation, or maybe when we start looking at the documentation, there seems to be something missing on it. Well, this is not necessarily direct evidence, but the indirect perspective as we're looking at evidence is going to provide some guidance for us in terms of what additional things we may want to look at. When we're looking at the reliability of evidence, we need to judge it by its ability to provide convincing, or if not convincing, at least persuasive evidence related to the audit objective being evaluated. According to the text of the ISA 500 or the A31, the reliability of audit evidence is influenced by its source and its nature, circumstances under which it is obtained, including internal controls for the preparation and maintenance, as well as generalization about the reliability of various kinds of audit evidence. These are subject to some important exceptions. When we consider evidence, we need to consider that the evidence that we're going to get is primarily going to be internal. In other words, evidence that's being provided to us from the organization. External evidence is evidence that we acquire outside the organization. So if we request confirmations from customers, we are going outside the organization and confirming balances directly with the customers. If we're requesting bank statements directly from the bank, this is another example related to external evidence. Internal evidence, generally speaking, is considered less reliable. Reliability depends upon internal control effectiveness, management motivation, the formality of documentation, and independent document preparers, which is one of the reasons that we do our internal control testing before we actually do our substantive testing, because it's critical from our part to understand how internal controls are actually going to provide an assessment of the reliability of the evidence. And again, as we've talked about some examples of external evidence, the question related to its reliability are, was it prepared by a knowledgeable and independent outside party, and is it received directly by the auditor? Evidence from management specialists. Now, one of the things that we do as we are planning the audit is determine whether or not we need management specialists to help us with the audit. As an example, we may need specialists as they relate to valuation. Maybe there's inventory that we're unable to value, so we request the assistance of a specialist. These are individuals or organizations that possess an expertise in a field other than accounting or auditing. Now, they may assist in preparing the financial statements, which becomes very interesting because management specialists do not, by definition, need to be independent. However, what we need to do is we need to consider the following factors: the competency, capabilities, and objectivity of the specialist, the work performed, and the appropriateness of his or her work as audit evidence for relevant management assertions. These are some examples of audit procedures. Now, we're going to talk a lot more about audit procedures in our next lecture, but let's sort of focus in on a couple of items and talk about how these are used in terms of acquiring evidence. So you notice the items here: inspection of documents. Generally speaking, when we are inspecting documents, we're inspecting documents to look for items that validate that internal controls are actually functioning appropriately. Inspection of assets, we may be doing this from an internal control perspective, but we also may be doing this from the perspective of testing the existence and completeness of assets. The two items, observations and inquiries, are generally speaking internal control testing, and essentially what we're doing here through observation and inquiry is gaining an understanding of the risk of the organization as well as the internal control structure and how these controls are actually operating. External confirmation, generally speaking, when you see the word confirmation, you can assume that this confirmation is directly related to a substantive procedure. And we'll talk about some of these others. Analytical procedures, as an example, is a test that we use as part of our risk assessment. It's a required test for our risk assessment. It's also a required test that we do at the end of the audit, but analytical procedures can be used as part of our substantive testing. Going back a couple of slides, we mentioned the term that what we do is we measure the risk of material misstatement. Based upon the risk of material misstatement, we determine the nature, timing, and extent of our audit procedures. Well, the timing is critical as it relates to determining our detection risk that we use in relationship to the audit. So let's talk about what we mean when we're talking about timing. Well, there's three periods within the audit that we're interested in. The interim period is the earlier than the end of the balance sheet date. So in other words, we may do testing before the balance sheet date. At the balance sheet date is exactly what it means, and the determination of when we actually do testing is going to be based upon our assessment of risk associated with the account, the effectiveness of internal controls, the nature of the account, as well as the availability of audit staff. So as we describe in the audit risk model, the higher the risk, the greater determination that we should have to do our testing at the balance sheet date. Roll forward period between the confirmation date and the balance sheet date. So if we're doing our testing in this interim period, it's critical that we actually roll the amounts forward to the end of the period. So basically what this is saying is that if we test things as of December 1st, then we've confirmed that December 1st balance is appropriate. Well, we need to roll forward this to December 31st balance and possibly do some additional testing in that roll forward period to validate that the financial statements as of December 31st are presented fairly. Cutoff period, this covers the several days before and after the client's balance sheet date. And what we're concerned with primarily in the cutoff period is the issue related to recording transactions in the wrong period. The cutoff test applied to transactions reported during the cutoff period provides evidence as to whether transactions have been reported in the appropriate period. So this just gives us a very brief understanding of what's taking place, and we'll give some examples specifically of what kind of testing we're going to be doing in this interim period, the period before the audit, in the cutoff period, and then in the subsequent period. And the subsequent period is through to the point of the completion of the audit. This gives us a very brief background related to audit testing, related to the evidence that we're acquiring. And again, we're acquiring the evidence for internal control perspectives. We're also acquiring evidence so that we can measure monetary misstatements. In our next lecture, we're going to talk specifically about some of these procedures that we're actually going to be using in the course of the audit. So I thank you very much for your time, and looking forward to talking to you soon.